Welcome back. Well, we're going to have a little bit of fun looking at a very common trading expression, sell in May and go away. The premise is that the market tends to perform better in the first half of the year as opposed to the second. So many investors will say, whatever money you've made by the end of May, sell your stocks, and that'll be the best performance for the year. We're going to take a look at the data. This is the average monthly performance going back to the year 2000 through 2022. We have the x-axis across the top are the months, January, February, so on and so forth, and then the years going up and down. Now we can see on the right-hand side we have the average monthly performance by year. So if you take the average performance for that year, for the year 2000, on average every month, average about 1%. In the year 2009, every month a stock market, meaning the S&P 500, averaged around 2% return. If you look at the bottom, this is the average by month, meaning across all over the past 22 years. The average for January is minus 1%. The average for February is minus 1%. So we look at this, and it's not very conclusive. So let's take a look at the data from a different point of view. This is the average monthly performance graphically. Again, January and February tend to have down months. March is up 1%, April up 2%. Now, of course, we're covering many years in very, very different conditions, different interest rate conditions, different trends that are going on. But so far, we don't see a strong correlation. Well, if we were to pick the absolute best day of the year, every single year, and buy the S&P 500 and sell it on the last day of that year, if we were to know what was the best day, these would be the returns. If we were to buy the S&P 500 on the very best day, meaning the lowest day for the market in the year 2009, we would have made 65%. In 2020, 68%. On average, we can see we'd make over, maybe 20, 25% on average for the year. But this still doesn't answer a question. We can compare the first half versus the second half of the year. Now, the first half of the year is January through June. The second half is July through December. The red histogram bars show us the performance on average for the first half of the year. The yellow histogram bars show us the second half of the year. We can see visually, it's not very clear, but it looks like that for the red histogram bars, there's more of them that are above zero. And for the yellow, it looks like there's more below zero. Well, actually, there's probably more for both above zero, but it looks like there's more yellow below zero than red, meaning that there's more years on average that the market underperformed during the second half of the year than the first half of the year. But this isn't a very scientific approach. Graphically, it looks pretty evenly dispersed, but maybe a little bit more of a tendency towards the first half of the year. Well, let's take a look at the data from this point of view. Let's say we were to buy the S&P 500 on the first day of every month. Just select any month and sell it on the last day of the year. So, for example, take a look at March 2009. If we were to buy the S&P 500 on the first day of March 2009 and sell it on the last day of 2009, we would have made 59% return on investment. If we were to buy the S&P 500 on the very first day of July 2008 and sell it on the last day of the year, we would have lost about 30% on that investment. Well, these are the averages by year on the right-hand side. The S&P 500 was down 26% in 08, up 21% in 09, down about 7% last year or so. Now, this is an extremely scientific approach, but take a look at the very big years. 2003, on average, and this is the average performance by month, meaning if we were to buy the stock market on the first day of the month and sell at the end of the year, on average, the greatest amount of returns in the year 2003 would have been made in the first few months of the year. If we were to buy in January and sell at the end of the year, we would have made 22%. If we were to buy in February and sell at the end of the year, we'd make 29%. If we were to buy in March and sell at the end of the year, we made 33%. If we were to buy in October of 2003 well, we would have made 9%. Now, of course, there's less time between October and the end of the year. But the point being is that it looks like, from this point of view, when we look at the big years, if we expect the stock market to go up a lot, those returns are accomplished early on in the year. Take a look at 2009. If we were to buy in the early part of 2009, let's say March, we would have made 59%. April, 37%. If we were to buy in November of 2009, we only would have made 7%. Now, of course, again, there's less time between November and December. But then again, there also could be the tendency that the stock market craters. October is historically a very bad month. Why does the data not show us that we would make a lot of money the last 2 months of the year? This data does suggest, if we look at the big months, or the big years, the years we have superior performance, like 2013, up 14% on average for the year, those returns were accomplished early on in the year. 2020, we know obviously that the market went down a lot at the beginning. If we were to buy, the low was accomplished in April. So this does suggest to some extent that buying at the early part of the year on those years that we have superior returns, those returns are usually made earlier on in the year. Now, the x-axis at the bottom, from the negative 4% all the way to the positive 2%, shows us the first half monthly performance. So if we were to ask, well, based on how the market acts on the first half of the year, January through June, statistically speaking, how does it tend to act on the next 6 months? Does it follow through? Well, this is what the data suggests. If the market, statistically speaking, is down 4% on the first half of the year, statistically speaking, the second half of the year, it's down 0.06%, almost zero. When the market is down 3% in the first half of the year, it follows through and loses another 2.36% on the second half of the year. Conversely, if the market's up 2% in the beginning of the year, it tends to accomplish another 1.8% on the second half of the year. So that does suggest that buying earlier in the year, or the returns we see earlier in the year, are better than later on in the year. We can take a look at the average monthly performance by year and also the interest rate changes. This shows us how much, the red line shows us how much interest rates changed by year, meaning how much were the federal funds rate at the beginning of the year, how much were they at the end of the year, what was the change? Well, 2009, 10, 11, interest rates were near zero, so that doesn't count. They didn't change at all. But take a look at this. When interest rates started to creep higher, the performance shown by the white histogram bar started to decline. In 2013, we were up 2%. In 14, up 1%. However, and that's the average monthly performance. So by month, in the year 2013, on average, the S&P 500 went up 2%. Now, conversely, when we see that the interest rates really started to rise, and the interest rates went up 1% in 2018, well, in 2018, the stock markets, on average, lost, very negligibly, but did lose money per month. Now, as interest rates really went down, we know what happened in 2020 with the stock market. Well, the Federal Reserve aggressively cut interest rates. Seeing those cuts, well, we can see in 2020, on average, the S&P 500 averaged 1% a month, which, if you annualize it, that turns out to be, quite superior returns. Well, of course, we know the Federal Reserve has raised interest rates very, very aggressively through the end of the year. And this is 2022, and we know the S&P 500 was weak as a result. So, in conclusion, we can say that sell in May and go away. I think it is true to some extent. I think it has to do, not only with the specific months. The stock market tends to be more active during the earnings seasons, January, April, July, October. So that's certainly something to keep in mind. We should also take in consideration the overall trend. the interest rates, inflation, all these other big economic numbers, which we didn't incorporate here, but they certainly do play a role. But during those years, and again, it's very interesting, during those years that we do have superior returns of 12, 14, 15% for the year in the S&P 500, the data does suggest that those returns are accomplished earlier on in the year. So we'll revisit this as we approach the end of May and June to see how we wrap up the beginning of the year, and maybe we can project how we think the S&P 500 will do towards the end of the year. We hope this has been helpful. We look forward to seeing you back soon.